Okay, we're just about to get started. Looks like several of you folks are already joining us. We will be starting this live broadcast in one more minute. I just want to give a few other folks some time to log in. If you're just now joining us, make sure that you do have some pen and paper because there'll be a lot of really great notes that you'll want to take. I'm actually going to go ahead and start right now. Hi, everyone. My name is Dale Price. I'm the founder of Access College America. We're a national provider for college planning guidance, and it's my pleasure to welcome all of you to our nationwide webinar. In just a few moments, I'll introduce our presenter, but first I'd like to go over a few things with you. So again, make sure you have pen and paper handy because you'll want to take notes on this. First, today's webinar will be recorded and put on the Access College America website. You can visit that at accesscollegeamerica.org. We recently revamped our website and it now includes quick links for college planning, newsworthy updates for today's prospective college student, parent articles and advice, plus a Scholarship Central page featuring over 100 scholarships plus so much more. And the best part is it's all free. So make sure that you do visit accesscollegeamerica.org. Next, we're live streaming this on Facebook. So for everyone that's tuning in from Facebook, hello. If you're watching this at a later date, maybe it's already been recorded, definitely share this with your friends, give us a thumbs up, and leave us a comment or questions. And then for those of you that are tuning in on Zoom, that's great. Keep the conversation going. If you do have questions during this webinar, you can click on the chat box or the Q&A box, ask those, and hopefully we'll have time at the end of the presentation to have Dana discuss that. Finally, I invite you to submit your questions again throughout the presentation, but if they are specific questions that are relevant or maybe too specific to cover that requires more of a one-on-one session, we'll do that at another time. So at this time, I would like to introduce today's presenter, Dana Timchenko from Morgan Stanley, who will be talking about financial planning for college admissions. And Dana Timchenko is a certified financial planner and financial advisor at Morgan Stanley who has a passion for helping build confidence and financial security for clients and their families. She joined Morgan Stanley because the firm values are the same as hers, leading with exceptional ideas, always putting the client first, doing the right thing, and giving back. Dana's practice concentrates on working with individuals in the accounting field, helping navigate their complex restrictions, benefit plans, and compliance requirements while driving the returns needed to help accomplish their goals. Every client is unique, so the mission in working with each family is to uncover the specific goals for their wealth, to put a financial strategy behind their purpose in life, and work diligently to execute that plan. So at this point, I'll go ahead and turn things over for Dana, and we will begin the presentation. Thanks.
Thank you so much, Dale. Thank you for the wonderful presentation, and thanks to everyone who's tuning in on a Saturday evening. I know it's what I want to do, and it sounds like it's what everyone else wants to do as well. You know, all jokes aside, this topic is rather serious since it is, you know, such a major moment in everyone's life, going to college and also finding the funding for it. Thank you to Dale for putting this together. It not only shows his passion for helping his students and their families, but also for offering a wide range of services. So not just on the admission side and essays and scholarships, but also helping you put all the pieces together. So thank you, Dale. And I will say as an aside, Dale and I met through one of the principals of Morgan Stanley, Giving Back. We both met at a philanthropic financial literacy event where he was sharing his knowledge with one of the Title I high schools here in Charlotte. So we both share a deep passion for what we do and look to help people achieve the things that they want. When I say I'm a certified financial planner, really what I do is I put strategy around people's money and their savings. So what do you have to accomplish your goals, and how can we get them done in the most efficient and strategic way? And that's our goal today. What we really want to do in this call is to present to you the nitty-gritty, the ins and outs of how to finance those 4 years of college that will put your son or daughter on the right path towards financial independence, and, happiness in the workplace, what they'll probably be doing for the next, 30 to 40 years of their lives. So what we'll do, and the purpose of this today, is to cover a couple topics on the agenda. What is the cost of college? The sticker price and the real price. Then going through some of the terminology, and then, getting into what are some tricks and tips, the savings versus borrowing. And then finally, I want you to walk out with some real strategies that you can put in place yourself to better position your son or daughter for college and to be paying less in costs. So without further ado, I'll get started. When we think of college, and if there are two things I want you to walk away with, it's the first, this is a hefty expenditure in your financial lives. Right up there with funding retirement, buying your first home. College is one of those really large expenses that, basically looms over our heads since our children are born. We know that we're going to have a pretty high cost. And in the United States, college is getting more and more expensive. But what I'd like you to walk away with is, please don't view this one large spend in isolation. It should be part of your overall financial plan. And what I like to liken that to is when you get on the plane and the stewards are going through the mask, put yours on before helping others. It's the same thing when you're thinking of college. Please don't think of it in isolation. Please think about, funding your retirement prior to college, because you can borrow for college, but you can't borrow for your retirement. So let's put the strategies together to be thoughtful about that. So that, I would say, that was definitely one takeaway I'd give to clients, students, and families, because it is a hefty cost. And colleges are businesses. And why does it come at such a high cost? Because it's very crucial to the future success of our children. Studies show that when our children get college educations, they earn more, they're healthier, they're more satisfied in their work lives. And, it's often the place that they meet their lifelong friends and colleagues from work. It's a network when they finally get out and do look for a job. And sometimes it's a place that you find your partner. I know that's where I found, my partner, Dimitri. So it carries a lot of weight, and so it's not to be taken lightly. And nowadays, to get a job, having a college degree is table stakes. It gets you in the door. It doesn't necessarily get you promoted, but it's essential to getting you, those jobs. So it's very important. And it all begins with academics. And this is where I think, nothing can replace a good transcript, good grades. And you can, you also look to a college coach to help you achieve that, someone like Dale. So it starts with the grades to get you into college. And, whether you're in your final year and looking at those acceptance letters, or you're gearing up in your freshman, sophomore, or junior year and starting on that path of, making the right choices for summer programs and things like that, all of that focus and energy goes into the final result, which is getting into a college, getting that acceptance letter, and knowing where you'll be going for the next 4 years. So let's parse it out. Looking at this page, it's the cost of college attendance. I picked Texas A&M not because I went there. I just want to give a shout out to Texas. I was recently there about 2 weeks ago and love Texas. But we're going to use Texas as our model for what is the cost and then what is the true cost. So looking over this, you've got the sticker price. And just like with any other big purchase item, be it a house, a car, or anything of that nature, the sticker price is not the actual price. But let's go through it. You've got your in-state tuition, then you have room and board, books, and other ancillary. When you talk about other expenses, that could be parking to get on campus, it could be room fees, it could be laboratory fees, anything like that. The in-state tuition, there's not wiggle in that. Room and board, books and supplies, and I'll talk about this later in strategies. This is where, if the budget gets tight, this is where you can start deploying some of these strategies. And I'll tell you early on, you can borrow books with the rise of the sharing culture that we now have, not just with Uber, but you also have the same sharing culture with books and other types of supplies. So you can look to that to cut some of the costs. Room and board. You can look to sharing and having a roommate and things like that. So don't be caught off guard by the sticker price, but know that that's your starting point. Just like you were negotiating with the car, to buy a car, that's your starting point. But that sticker price for Texas A&M equates to, over the next 4 years, $113,000. So that's a pretty hefty cost. Let's see how we can knock that down. What do you really end up paying? Because nobody pays a sticker price. I know I don't when I'm buying a car, and you probably don't either. The average for Texas A&M that a student will be paying is $19,000, not the $28,000 sticker price, but $19,000. And how does it get to be such? Well, through a variety of yours, mine, and ours, you reduce the cost by getting someone else's money, their money, which is grants, scholarships, maybe a Pell grant. You can reduce the cost, and then you can take student loans out. What I really like is the bar graph below that kind of shows on the gauntlet what you're actually paying out of pocket and where you're sourcing out money for from other areas. So if we're looking at a net sticker price of $28,000, you're coming up with $60,000 of that, and $44,000, roughly $40,000, is going to be coming from gift money, scholarship money, grant money. So where do they come up with those figures? How much you pay and how much you get from someone else? Well, with the cost of college becoming, increasingly more expensive, colleges don't want to discourage academically gifted students or students in need from applying to their universities by virtue of the fact that they can't pay. So they've devised a system with the federal government where there's the sticker price of college, and then they figure out how much each family can afford to pay for that tuition. And then the net remainder is how much you should qualify for needs-based funds. So someone that makes $50,000, the $28,000 cost of college is prohibitory. They can't make it. So the expected family contribution is less for someone that makes $50,000 than it is for someone that makes $250,000. And I will, kind of give the down and dirty that maybe they don't talk about a lot, and that is the fact that in general, if you make more than $100,000 to $150,000, you are going to be on the hook for most of that tuition. So your expected family contribution, EFC, and you hear that all the time, your EFC is going to be relatively high. But don't discourage that. Don't let that discourage you from applying to the more expensive universities that your child wants to go to, because we'll show in subsequent slides that universities that have larger endowment funds, richer universities, have more money to give out in scholarships and grants. So how do they figure out what your EFC is? Well, the magic FAFSA, it's an alphabet soup here. The magic FAFSA will tell the universities how much your EFC is. And FAFSA stands for Free Application for Federal Student Aid. And I'm sure Dale can go into that a little bit when you guys get to the point where you're looking at applications and things like that. He has extensive work on the scholarship side and knows that everyone should file a FAFSA. That was something that I learned in one of his seminars. And you really want, whether you are looking for financial aid or you're not, you want to file for that FAFSA. A, it opens you up to options that maybe you would limit yourself. And B, some scholarships want you to file a FAFSA regardless of whether you can pay for college out of pocket or not. They still want to see it for scholarships. So if we're going back to the example of Texas A&M, the cost of attendance, say, is $28,000, and your expected family contribution is $10,000. Well, then $18,000 of that needs to come from, is up for play for needs-based funds. How is FAFSA calculated? Well, I'm going to go into depth on how FAFSA is calculated because it is so crucial for determining that EFC. There's some play in this number. So there are some strategies that you can deploy to make your EFC low, thereby making your eligibility for needs-based funds higher. And if you, if you're paying for college, you want to pay for as little of it as you have to. So it's calculated and weighted heavily towards what the parent's income is, what the child's assets and income are, and then what the parent's assets are. So heaviest on the parent's current income and how much money the child has in their name, and then only third, how much the parent actually has in their name. So it's not going to penalize people for saving well, but it does penalize higher income earners. And it does penalize children for working. It sounds terrible, but really, if a child works, a job or two in the summer or winter, and has an income to show for the last 2 years, they are going to be penalized and expected to pay for college out of that income that they've made, and also their assets. So if you have grandma and grandpa and they've been contributing money, to your child's savings account, you may want to rethink and house that in another asset, so that it's not in the child's name. Because again, the way the federal government is thinking about this is, well, the kid is going off to college, they should pay more out of pocket since any of their money should be going towards college. They made that decision, we didn't, but we do have to go with it. And then last, the parents' assets. So actually less of your savings is calculated in your EFC, your expected family contribution, than you would normally think. But taxable assets, like a checking account, a savings account, an investment account, those are weighted more heavily towards your EFC than your 401k and other savings. Another thing to note is if you have multiple children in college, or you will have them in college, or you're an older parent, you're expected to pay less because you're closer to retirement and you're going to have more of a burden with more children to put through college. What is excluded from FAFSA, and is interesting to note and to use to the best of your ability, is to house assets that you have in those exclusionary items. So the home equity in your house, say you have your house fully paid for, you're not considered having to sell your house to fund college education, and that's a good thing. All of your retirement plans, your 401k, your IRA, your Roths, those are not considered in FAFSA. Annuities, cash surrender value inside of life insurance is also not included. So when you are close to, filing, you want to start thinking close to, is about 4 years out. Start thinking about the structure that you have your assets in and how you can reduce the assets that the government's going to count for FAFSA, so that you have less of an EFC, an expected family contribution. I'm not going to go into simplified expected family income too much, because if you are making less than $50,000, you can do a simplified version. But if you're making less than $50,000, you're in that sweet spot where you're going to be the beneficiary of a lot of need-based aid. You could still qualify for a Pell grant, which I call the unicorn, since they're very rare and hard to get. And you'll also qualify more for scholarships. So if you're under the 50K bracket, you're good. Anything above, you're really going to have to start to strategize. And one more thing to keep in mind is the government is backward looking on your assets and not forward looking. So this can be a detriment to people that either are making less in the year that their child goes off to college, or they're going through a divorce, or something that drastically changes their financial outlook to the lower end. They, unfortunately, the government's not looking at that. They're looking 2 years prior. So the class of 2019, the government is actually looking at the 2017 income. And why does that have bearing, and why are we going over that right now? Well, A, if your income has changed 2 years after, if it's 2019 and your income is drastically different from 2017, then you want to apply for your FAFSA application, and you also want to put in a letter of explanation saying, this is why my circumstances today are not the same as they were in 2017, so that the government can review and look at your circumstances now as they stand. Also, something to keep in mind, since you do the FAFSA every single year, if your circumstances do change, you want to include that letter of explanation. So that's a nice little tidbit for you to know. But if your child's going off to college in the next 2, 3, 4 years, start thinking about that. So you can suppress income. If you have things like restricted stock options or regular stock options. Don't option those. Don't, put yourself in a position where you're going to be getting a whole bunch of money that's going to show up on the FAFSA. One more kind of profile to go through in addition to the FAFSA is the CSS, the College Scholarship Service. Now, right now, not so many colleges use it. About 250 colleges use the CSS profile as opposed to the FAFSA, and they're mostly your private institutions. So your Duke, your Harvard, your Yale, the Ivies use a CSS. And if FAFSA takes about 2 hours to complete, the CSS is going to take you darn nearly a whole day. They want a lot of information. They want it on both spouses. They do include home equity and paper losses for businesses and other things. So they're really diving a whole lot deeper, trying to get to the truth of how much you can afford to pay for college. And that's because these wealthier universities are trying to really get to the bottom of who's in more need of their scholarship money. So again, FAFSA tips to consider is saving strategically. So save more in your name versus the student's name. If you have money in the student's name, try to pivot out of that before you have to put your FAFSA application in. Minimize assessable assets. That's saying save in a tax deferred, like a 401k IRA, before you save on the taxable side. And minimize your income in the base year. Those are a couple easy things that you can do to minimize your EFC, thereby increasing the chances that you'll get grant money. So we talked a little bit about your money. Let's talk about their money, aid or free money. You have a number of different sources that you can get that free money. Anytime you hear grant, think gift, think free. Which is also another name for scholarship. So every institution, every college and university has their own bucket of money. And that's gotten to be more and more crucial as time goes on, and the federal government and the states a lot less and less of their budget to colleges and universities. So they're beefing up the institutional aid that they can give your student because they want to entice your student to go to their college. And then you have sources like grants and scholarships, which Dale can definitely help with and has resources on his website, so you can look at those scholarships. This is all free money that does not have to be paid back. So this should be the first source that you look at, and something that you can do on an ongoing basis. So not just your senior year applying for those scholarships, but continue to apply every single year and applying for them a little bit earlier than you need to, since most of them require an essay or something of that form. And that accounts for roughly 21% of the money that you'll be using towards college. Some examples of institutional aid for Texas A&M, since they're our example for this lesson, is the Lechner and McFadden scholarships are scholarships that are just merit-based. You don't have to be destitute. You don't have to be financially strapped to qualify for these. So this is some easy reach money for students that are already in a position where they have a high GPA level, and they're going to be going to Texas A&M. They will get this money. And it's on an ongoing basis. As long as they maintain their GPA, they'll continue to get it every single year. UCLA has their own scholarships. Shout out, since my niece just got in there. They have a Regent scholarship, and then they have an alumni scholarship. So every single college that your student's going to be looking at is going to have their own flavor of institutional aid, the money that's at the disposal of the university to apply towards students. And then you've got private and employer grants, AKA scholarships. It says that 7% of aid distributed on a national level, but it can be more or less give or take. I would say definitely look at your employers to see if they offer any scholarships to children of their employees, since that can generally be easy money. And another thing that I learned from Dale's seminars is go for the lower dollar amounts. Don't go for the high, $20,000 scholarship, because there's more competition. Go for those little 500, 1,000, 750. They add up. They're merit-based. Some are need-based, but these are the more achievable buckets of free money. And then there's a Pell grant, the unicorn, you know, you have to make less than a family income of less than 50,000 in order to get this. And the maximum is 5,920. So it's something that may be out of reach for a lot of us, but the grant money is there. So we talked about your money. We talked about free money. Let's talk about borrowed money. Federal loans is the first place to go. Why is the first place to go? Well, the interest rate on the federal loans or Stafford loans, I think a lot of us have heard that term. A Stafford loan is a federal loan for tuition. The rate is typically lower than any other type of funding for college. They have two flavors, subsidized and unsubsidized. Subsidized means the federal government is paying your interest while you're in college. Unsubsidized means that you are paying the interest and it's accumulated and growing. So there are some perks. Also, when you're borrowing in this capacity, you can then write it off on your taxes to a certain degree. So this is one of the first and easy places to go. And this is the main reason most people file a FAFSA, is because in order to get these federal loans, show me your FAFSA. So this is a great thing to look at, is getting some federal money. Now there are other places that you can borrow from. There are private lenders. SoFi, I know, is really big in that space, and you can borrow from other places. But this is a loan that, you know, it's very specific to college. Another thing to note: when you're taking these loans on, they are not forgivable. Not for bankruptcy, not under any circumstances. Now, there has been talk about these being forgivable if you work for, you know, if you pay them off for 20 years and then just never pay them off. I don't think that's a viable strategy, because you don't want to be in a position where you can't pay off your loans for 20 years. That means something's gone drastically awry, you know, in your career. So we've not seen that successfully work itself out. So I would not say that that's a viable strategy. But here's a little bit more on the interest rates for undergrad and graduate, and know that there's a cap off on these. So just flipping right back over, you can only borrow so much each year. So if you need to borrow more, you'll have to borrow from other sources. However, when you borrow, think about saving versus borrowing. If we're talking about $34,000 over the next 10 years, if you save for it, you only have to save $200 a month. If you borrow, you're paying $396, so almost double. And keep that in mind as you go forward in your strategies and planning. Saving outweighs borrowing any day of the year. But if you do have to borrow, there are home equity lines that you can borrow from. You can borrow from your 401k. And I could talk offline about that, using that as a strategy, since it's not actually as detrimental as borrowing from other sources. But let's take a look at a sample financial aid letter, because you get the letter of acceptance, but you'll also get a financial aid letter from the college. And here's just an easy to read sample detailing out what the cost of college is going to be and what they're offering and enticing your child with in terms of grants, gift, free money, and in terms of loans. If you look at the green arrows, green is good, green is free money. Those are your Pell grants. The Elite College Award, this made-up college is called Elite College. The Elite College Award is just free money that they're giving to your student, along with state grants and other things. The red arrow is showing the money that you're going to be borrowing, and they don't always delineate what is borrowed money and what is free money. So you need to know, grant is good. Anything else falling under the loan category is going to be a debt that you're going to accrue. And some of the colleges will offer you loans from their own, private universities. Again, going back to kind of the car dealership, if you borrow from the car dealership, it's easy, but it may not be the best rate. So broken down this way, they're telling you that the cost of attendance is $62,000, and then in awards and loan money, you've got $41,000 covering it, so you're out of pocket $21,000. And when you get these letters, one of the strategies, you can actually play one institution off of another, and I'll show that in subsequent slides. So you can say, my son or daughter really wants to go to your college, and you write this in a nice way in a letter to them. However, they have a competing offer and the university is going to give them, you know, $5,000 more in award money. Can you match that? So there is room for negotiation. Just looking quickly at 3 offers from a public college and 2 private universities. For someone where their expected family contribution is $15,000, you would think the public college with the lower cost of admission would be the better way to go because the other 2 private institutions are oh so much more expensive. However, private institutions have more money to give to your student in grant, which is free money, to entice them to come, whereas public colleges really don't have that money. So of the 3 offers with the same EFC, your private college A is actually going to be net $20,000, so about $4,000 less than your public institution. And this you'll start seeing when you get those acceptance letters and they're actually detailing out the cost of attendance. So how will you actually fund college and making the most of your finances? We talked about free money, grants, scholarships, and merit-based aid. We talked about borrowed money, federal loans, but let's talk about your money for a second. Some of it's going to come from cash flow and some can come from investment in savings. I would think, you know, liken it back to when you first bought your very first house, and maybe you were cash strapped, you'd save some money for the down payment, but you needed a little help from mom and dad, and then you did borrow the bulk of it from a bank. It comes from multiple sources, and sometimes it doesn't always come from one source. So on the savings side, I think one of the most effective vehicles for you to save for college is the 529 plan. Some states have a prepaid college tuition plan, but that really locks you into going to a university in that state. And we don't know where our children are going to end up. So it's not versatile and I would say not generally recommended unless you're so tied to your state university that you say, my son or daughter will only go here. 529 plan, it's more expansive. You save on a tax deferred basis, which means as it accrues and it grows, you're not paying taxes. When you go and you take it out for qualified higher education, it's tax free. Also with the tax changes in 2018, you can also use that money for K through 12 up to $10,000, provided again, it is for educational expense. So it's very versatile. You can also change between beneficiaries because the parent owns that money. Again, we're putting the bucket of money in the parent side, not the child's, so that we're not messing things up with FAFSA in your expected family contribution. So you can change the beneficiaries. Say you have a general pot of money, $50,000, and one child gets more scholarship money than the other. You can shift some of that money over to other children. If you do need to take it out, it is a 10% penalty on the accrued earnings, and then the earnings are taxable, which actually, if you've had it 10 years or more, is not much of a tax hit. It's roughly the same as if you kept it in taxable monies. Some states, like Oregon, noted below, do offer you a tax deduction. North Carolina does not, neither does Texas nor California. So check your specific state. I know Pennsylvania does, and there are a number, New York does, and there are a number of other states where if you live in that state and you save in that state, then you can get a tax deduction. Is it too late for a 529? Well, it's never too late to save if you ask me. So here's just an easy kind of cliff notes. You know, if you have a freshman or a sophomore, you still have some time to put in savings and have it grow for their college tuition. Also, there are UTMAs that you can save. That's money that's gifted to a child. UTMA stands for Uniform Transfer to Minor or Uniform Gift to Minors Act. But again, earlier we talked about FAFSA. You want less money in the child's name, and this is money that is completely in the child's name that they do not have to use for college. They could use it for college tuition. They could use it for a Ferrari. You cannot tell them what to do with that money, and they get that money at age 18 or 21, depending on the state rules. So while it is a savings mechanism, it may not be the most versatile. And then lastly, there's a Coverdell savings account. This one has a max of $2,000, but it is more versatile in that you can use it for K through 12, or you can use it for college. It is tax deferred. There are income limits, but you can do what's called a backdoor Coverdell, and I can talk about that offline. And it has a low impact on financial aid. There's also a tax write-off. If you are borrowing money, you can write off the interest towards that you're paying for, specifically for college tuition, from your taxes. It's not a high amount, you know, about $2,500, and then based on your joint income could be less or more. So I would say don't bank on it, but it's nice if you're having to borrow to at least be able to write some of it off of your taxes. I would say next steps, if you're in the process, or next year you'll be in the process of sending your senior, sending the applications out, do the FAFSA. FAFSA opens up October 1st. You want to have that in as fast as possible. And the reason being is once they calculate your EFC, your expected family contribution, that's when they start doling out grant aid from the government. So the sooner you get your application in, the sooner you put your place marker in to get that free money from the government. And there is not enough to go around. So be there first. You don't have to have a college to apply it to. You just have to have your application in. And then what are some strategies? Well, I talked about them along the way. But first, when you get that sticker price and you know what it's going to be, think and talk over cost reduction strategies. Is there a way to take a summer program while your child's going to college to get some credits at lower costs? Textbook, like we talked about, the crowd sharing, the sharing economy where you can share your textbooks. Health insurance. It might be cheaper to use the university health insurance than your health insurance. So these are all things to think about. Getting a roommate versus going to a dormitory, or getting a couple roommates in an apartment to share the cost. So those are things you can do to drive down costs a little bit, but also review your financial plan and how it fits into your college payment strategy. How much can you, as the parents, put towards the college tuition, and be very realistic about it, and don't shortchange your retirement to make that happen. Have this be an open conversation with your college student or your prospective college students, so that they know these are your finances. You don't have to disclose everything, but you know, to your son or daughter, we have $15,000 that we can pay per year towards your college. So let's plan it out and strategize. And then scholarships. Start applying now and don't stop. Continue during, you know, your first, second, third, and fourth year in college. And be prepared to negotiate. This is by no means the bill that they're giving you is the bill that it is at the end of the day. It's a little bit like healthcare now, where you can call up on a bill and say, will you give me 20% off if I pay it now? You can do that with colleges. You can also, you know, use one college's offer against the other and say, I have an offer and they're going to give me $5,000 more than you guys are in grant. Can you match that? So don't be afraid to haggle. You know, and negotiate to bring that cost down, because it is very expensive. And then last but not least, these are some of the resources. If you go on collegeboard.org, you can do a mock-up FAFSA to see what your EFC would be. How much on the hook will you be? You can also look at the colleges and see per college what the cost is, how much they end up giving out in grant money, because some give out more, some give out less. And what options they have for that merit-based grants. You know, if your child has a 5.0, they can get XYZ in merit-based grants. So the first two are really helpful for uncovering how much the cost could be for each specific college. And then for the state that you live in, I put in there, you know, the California colleges, College for All Texans, cfnc.org, which is the North Carolina website. Go check it out. There's a lot of resources and great material there for you. And with that, I'll close out by saying, hopefully you found this useful. I'm open to questions, and you know, this is not the end of the road. There are still things to be done to get your student ready for college and ready to pay that payment. But you're setting them off on a pathway towards financial independence, you know, greater joy as they have their own achievements, and just a lifetime of connections. And with that, I'll pass it back to Dale.
Great. Thanks, Dana. That was really, really great. I've got several questions here, but one that just popped up is, what would be the easiest way to pay off parent loans when a child is about to start college?
Oh, that's a great question. I would say, again, if we're referencing, put your mask on before you help others. Try and knock down your own student debt before you even commit one single dollar to your child's college tuition, because again, you're not going to be able to, borrow for your own retirement. So I would say, look at, if you have equity in your home, look at a home equity line of credit, and use that to pay off. Use some of your cash. If you've saved up some monies, use that towards paying off your student loans, because then you'll have less of an EFC on the FAFSA. 401k loans are also something that you can look at, because the interest that you're paying on a 401k loan, you actually pay it back to yourself. It's a little known fact. So those are some ideas.
Great. Can you tell me, another question that came in are all 529 plans the same? Where do I find out more information about a 529, and when is the best time to start a 529?
Oh, I'll start with the last one first. Start now. Start now, even if it's only $25 a month. Start now and save. And yeah, 529s. Every single state has their own 529 plan. Most of them aren't very different. The internal cost on each one of them can vary, but more and more they're moving towards low cost, your index fund, your fidelity options inside of these 529 plans, so they aren't expensive. California and New York have one of the lower cost 529 plans, but there are a lot of other cost effective plans. You don't have to buy one through a broker or an advisor. You can buy them directly. Every single state has a direct 529 plan, and you don't have to use a 529 plan in your state. You can use any 529 plan. I could go and open up a California 529 plan if I wanted to. So do a Google search, take a look, and always look at the internal cost.
So on that note, how do you know if you're shopping around for a 529 plan, then how do you know which ones are better than others?
You look at the cost, because they do have to state how much the investment options inside of the 529 plan cost. So are they using Vanguard or Fidelity? That's kind of your watchwords for they're going to be very low cost. Or are they using a mutual fund option? And they also show you what that net cost would be. So they have to show it, and it'll be a 1.2% charge. That's high. It should be around 0.5, no more than 0.5% for an internal cost.
Okay, great. We have time for one last question. This one came in from Facebook. Do you recommend a cap for student earnings in high school?
That's a really good question. Since I have a sophomore who works, I think it really builds character, and it's good to prompt them to go to college. Because if you're working some of those jobs, you go, I do not want to be doing this for the rest of my life. I would say, though, yes, you do want to cap it off, because it is such a huge drag on your FAFSA, on your EFC, on how much you're expected to contribute if your child works.
Okay, good. And then I guess I'll just squeeze this one in. When is another one from Facebook, when is a good time to take money from the student and put it in my name? Is that before the prior year?
Before the prior year, yeah, not to get goofy, but 2 years before you're going to have your student go to college and file that FAFSA, get that money out of their name.
Okay, good. And we do have some more questions, but for the viewers that are tuning in, you can see if you have questions, I definitely recommend reaching out to Dana directly. We don't have time to really answer all of these, but I do want to thank you, Dana, for taking the time to share this information. It was incredibly important. This goes back to finding the right college fit. When families are shopping for a college, 3 things they have to consider are the academics, the social fit, and the affordability. And all 3 of these things have to really fall into play. And so it's a topic that really is important, especially since the cost of college is on the rise. It's only getting more expensive. Registration is now open for our next free webinar. So definitely mark your calendars for effective essays for college admissions on Tuesday, June the 4th at 7 p.m. Central Time, featuring Kim Lifton, who is president of the WOW Writing Workshop. As for today's webinar, it will be saved on our website shortly. Visit accesscollegeamerica.org and feel free to share this with your friends or family. Lastly, if you know anyone looking for college planning guidance, let me know. We are now accepting clients nationwide, and we use FaceTime, Zoom, and Google Hangouts for guidance with academic planning, career and personality inventories, and essay preparation, among many other things. Again, visit the website to learn more. This concludes today's webinar on Star Wars Day, no less. So I want to thank you all for tuning in, and may the 4th be with you all. Take care.